Many economists now believe we're in an environment of falling interest rates. So the key question then is, how do falling interest rates affect your investment portfolio? How should you change your broader asset allocation between equity, bonds, property to reflect the fact that interest rates are probably coming down in many of the larger jurisdictions? The US and the UK, for example, this is where many economists have that expectation for the coming year or so. This is a key question, and over the next 20 minutes or so, I'll be going through in this video 3 of the key issues that you need to address, key questions that you need to consider in your portfolio, which will ensure that you have the optimal asset allocation to take advantage of this type of macroeconomic circumstances. I've been in the market for 30 years. I've been an asset manager and I've also been an investment banker, and I spend a lot of time managing my own investment portfolio. And I can assure you one of the most important things to consider is get that high level asset allocation correct. Try and make sure that the weightings you apply to equity, fixed income, property are all set in an appropriate way. So let's now look at some of the key questions that you ought to be addressing. So let's just start with an overview of the 3 questions we're going to look at. Now, the first one is, should I invest more in stocks, in equity, or should I invest more in bonds? People will typically tell you that in a falling interest rate environment, both of those will rally. Yet, which one is going to give you the biggest bang for your buck? That's the first thing we're going to address. The second is that if you're going to buy bonds, do you buy government bonds or do you buy corporate bonds? Which type of bonds should you buy? This is something you really need to think about very, very carefully, because each performs better under different sets of circumstances. And the last thing you might consider is that right now you're probably getting some very attractive interest rates on your cash. Is now the time to buy bonds, given that you might be getting a lower interest rate when you move from cash out into bonds? We'll have a look at some of the issues you should consider when you do that. So these are the 3 things we're going to look at in this presentation. So let's start by looking at stocks versus bonds. Which is the better buy in this type of environment? Now, in order to answer that question, I think we need to drill down further into analysing which bits of the stock markets and which bits of the bond markets are going to perform best when interest rates come down. So starting with the stock market, usually there are 2 categories of stocks which certainly in my view are most likely to perform better. One of these categories are what's called the long duration stocks, those where the payback comes further out into the future. This might, for example, be the tech sector, or for example, some of the smaller companies which are only paying dividends 5-10 years hence, but aren't paying anything out in the moment. These will have been particularly heavily hit when interest rates were going up, and therefore when they start to come down, you might reasonably expect these type of names to perform especially well. So when you're looking at your equity portfolio, try and segregate that sector which is more interest rate sensitive. The second part of the stock market which may perform relatively well when interest rates fall is those sectors which are heavily leveraged. Now, there isn't any particular area of the stock market where leverage is unusually high. Often you have to drill down to a single name, and therefore you may have to actually look at all of the names in your portfolio and figure out where is leverage high, and also look at where these companies have to refinance their bonds. That's one way of looking at the issue. The other is to say, is there any macroeconomic view I can take on this? And yes, there is. It's often the case, for example, that the real estate investment trusts, the REITs, are very highly leveraged. And what we've seen is they have been performing particularly badly when interest rates were going up. And therefore, some of these REITs are going to perform rather better when interest rates start to come down again. So there's no simple answer as to which part of the stock market performs better in a falling interest rates environment compared to a rising interest rate environment. So do be prepared to do the legwork. Look at individual stocks you own. If you're owning ETFs and you've just got sectoral views, then clearly certain sectors are going to benefit more than others. Now, the same, of course, applies in the bond market. One really important thing to consider is that the type of bonds which will perform best when interest rates are coming down are going to be fixed income bonds. The bond market itself is characterized by fixed income and floating rate bonds. Floating rate bonds pay a higher coupon when interest rates go up and a lower coupon when interest rates go down. That's clearly not the obvious sector to be buying in these type of circumstances. But there is an enormous sector of bonds which have fixed coupons, and this is the majority of government bonds and a large part of the corporate universe. Where they're paying fixed coupons, this is the type of investment you want when interest rates are coming down, because you can try and lock in 3, 4, 5-year interest rates from now and therefore protect your money. In other words, lock in current rates for 3, 4 or 5 years ahead. So when you're looking at the bond market, really make sure you're owning the right type of bonds. It's the fixed income bonds that you need to own. Now, even then, when you're buying fixed income, you've got to get the maturity right. Because what you will see is that bonds with longer maturities will typically perform better when interest rates come down than bonds with shorter maturities. This is called duration, and I explain it in much more detail in one of my paid courses. So you'll have to take a view. Do you want to buy longer duration bonds where basically you get more bang for your buck, or very, very short duration bonds of, say, 1 year when you won't get nearly as much capital return? It's also the case that low coupon bonds tend to perform better. We say they have longer duration as well. So you want to get the mix right if you're buying bonds between the maturity you own and the coupons you're getting, and of course, stick to that fixed income universe. So the key question, therefore, we need to address is this: do I buy the stocks in those sectors which are going to perform really well when rates come down, or do I buy the bonds in those sectors which are going to perform really well when rates come down? And that question is really tough, and there's a couple of issues that I think you really need to think about first. The first is that obviously both of them are probably going to perform well. However, look at the following issues. Issue number one is recession. If you think rates are coming down because there's going to be a major recession, chances are you don't want to be overly exposed to the stock market. In that case, you probably want to buy government bonds instead. Issue number two is inflation. If you think interest rates are coming down, but inflation has yet to fall, it may come down in a couple of years' time, then maybe you're better off being either in inflation-linked bonds, or perhaps stocks could be a bit better, because often robust companies will increase their dividends in line with higher inflation. And the other thing you want to consider is that if rates are coming down and you're going to have what we call a soft landing, in other words, there's not going to be a recession and economic growth will be slow, but it'll gradually pick up in the coming years. Do you really feel as though the bond market is going to perform that well? Maybe you're better off having that leverage to the economy that you're going to get from owning stocks. So a lot depends upon your view on the broader macroeconomic circumstances concerning inflation, recession, or whether we have a soft landing. And that will determine what your allocation between bonds and stocks might be. There's also one other factor which is specific to you. And it's this. Typically, when you're buying bonds, you're going to get a higher level of coupon than you'll get dividends if you're buying stocks. Stocks normally pay you quite small dividends. Now, clearly, if you would rather receive capital gain instead, stocks might be the better buy. So you need to consider your own personal taxation circumstances. And if your tax rate on capital gains is lower, or you have a capital gains exemption, this might push you towards owning stocks instead. If, on the other hand, your tax rate for income is really, really low, or you're managing to invest in some kind of account which is income tax free, then maybe you'll decide to buy bonds. So look as well at your own personal tax circumstances and, of course, which type of account you're using to own your bonds and stocks so as to make sure you get the best of those tax privileged accounts. So that's the first section, which is bonds versus stocks. Look at the macroeconomics and look at your own taxation very carefully. So the second key question to address is, do I buy corporate bonds or do I buy government bonds? Now let's elaborate a bit further on each of those two categories. Corporate bonds we can divide into two. There's those which we call investment grade, which are issued by companies with relatively high credit ratings, which are very remote from being declared bankrupt, and those which are called high yield, where the company is more likely to go bankrupt and therefore it has a lesser credit rating. The second subdivision we'll look at is in government bonds, between those issued by developed nations and those issued by emerging markets. Again, you might reasonably assume the emerging markets borrowers will have lower credit ratings and will be riskier. Now, for the purposes of this discussion, I'm just going to leave emerging markets out of this altogether. We're only looking at government bonds from developed countries. So, for example, we're looking at US Treasuries, UK gilts, bonds issued by Germany, France, Japan, etc. So how do you decide? Do you buy corporate bonds or do you buy governments? Now, the temptation is often going to be to buy corporate bonds. Now, the reason why that's so tempting is because corporate bonds trade at what we call a spread to government bonds. That is, they offer you a bit of additional yield. If you want to know more about the spread and why that spread exists, have a look at my website, details below, and we provide some courses on more details on investing in corporate bonds. But for the purposes of this video, you're just going to get a higher spread or maybe a higher coupon if you invest in corporate bonds. And in return for that, you're taking more risk because clearly corporates are more likely to go bankrupt than highly developed governments, and they also can't raise taxes to protect their income streams the way a government can. So how do you decide? You've got the temptation of the additional spread of the corporate bonds, or you've got that additional level of security that you might get if you buy a government bond. The answer is in the macroeconomics again. Why are you buying bonds? If you're buying bonds because interest rates are coming down and you expect a recession, you want to be very careful about buying corporate bonds. You want to be thinking, which of these corporates are going to be as recession-proof as I can possibly get? Now, that may mean you want to exclude the high-yield sector, and it may also mean you want to be quite careful about which sectors of the corporate bond market you're going to invest in. Government bonds, however, in a recession, the government should be able to finance itself by additional borrowing. It can raise taxes, it might cut spending elsewhere, but you should feel more comfortable that government bonds will be secure. If, however, you think there's going to be a soft landing, and you think that rates are coming down, but the economy is going to grow quite smoothly after that, then you might think maybe corporates will be in a better position in 6 months' time, a year's time, to pay down their debts, and therefore they will outperform the governments. In other words, you'll get that additional spread without really taking enhanced bankruptcy risk. You'll have to figure that out. Do bear in mind there are other factors to look at. Firstly, your own personal taxation is really important to consider. For example, in some countries, the capital gain you get on government bonds is tax-free, whereas it won't be tax-free in the corporate market. You may also want to consider that liquidity in government bonds is typically going to be higher than in corporate bonds, and that may push you towards the government bond market. And of course, you might decide there are certain maturities you like. You may decide you really want to buy longer dated bonds, and you might discover in your particular market that there's more available to you in governments. One last word of advice on making this decision. The whole bond market is extremely technical, and it helps to have a good mathematical background if you're going to invest in either of these sectors. So maybe consider buying a fund or buying an ETF, which will do that for you, but that won't take away the underlying decision. Do I buy a corporate bond fund or do I buy a government bond fund? Lots of technicals there to consider, but again, the message is the same as with stocks versus bonds. Look at the broader macro environment, look how that's changing, and don't be afraid to change your macro asset allocation if you see that the likelihood of a soft landing or a recession starts to change after you've taken out the position. So here's the next question you need to consider. Chances are you're looking at some quite attractive cash interest rates now, whether you've got the money sitting in your bank account or sitting in your brokerage account. Is now the time to buy government bonds and lock in to a 2, 3, 4, 5, 10, 30-year interest rate, which is probably lower than you're getting on your cash? That's a really tough question to address, since it really comes down to timing. Clearly, if you leave it too late, your cash interest rates are going to fall, you're not getting much return on your deposit, but interest rates that you can lock into have also fallen as well, and therefore you've impaired your long-term portfolio performance. Do it too soon, of course, and you might discover there is a better rate you can lock into in a couple of months' time, or you can take advantage of those extra high rates you're getting in your brokerage account right now. How do you decide? The answer is relatively straightforward. You need to make your own forecasts. And I would do it very simply on a spreadsheet rather like this. This is an example of buying a 2-year government bond and comparing that against the cash deposit. What I've done is I put in my forecast of what I think cash rates will be, and I've looked at what the return will be of $1,000 at the end of 2 years, and I've looked at the return on my $1,000 if I invested in a 2-year government bond. Based upon how you change your forecasts, you can see it'll be more compelling to go for the cash interest rates and leave money on deposit, or to go for the government bonds. Seems like a rigorous and technical exercise to go through. And of course, forecasting interest rates is always going to be tough. But I think that's the type of exercise you need to do. Look at the maths. Consider also what things might look like in a month's time or 3 months' time, and make your decision based upon that. Don't leave it to some sort of nebulous concept. Oh, I think maybe. Put the numbers down on a spreadsheet and look at the math. So there's 3 guidelines that you can use to help you invest in a falling interest rate environment and to make sure that your macro level asset allocation is really appropriate for the current market circumstances. I hope you found this useful. If you did, please do click like, please do click subscribe, as it'll help other retail investors find this channel.